back to accounting. I'm glad everybody is here for the second time. Hope your semester is starting off well. For you folks at home, if you didn't watch the first lecture, make sure you watch that. Don't just skip over that thinking it was non-important syllabus stuff. There's some important stuff there, and we started actually on the Accounting 1 lecture. We're going to go through some accounting basics today. It may seem like we're jumping around a little bit, but I kind of need to lay that foundation before we start really going into accounting. Okay, so it may seem like I'm talking on a lot of different little things, but they all do relate, and it is important to have that base foundation. One thing that I want to address, though, right at the beginning of class is sometimes people are like, why the heck do I need to take accounting? And maybe they don't want to be in this class. And, you know, of the 15 or 16 of you here, you know, truth be told, there may be only just one or maybe two that will actually be an accountant someday when you graduate, when you get a job. However, one thing I want you guys to realize up front is I would venture to say that at least half of you, maybe more, sometime in your life will either own or co-own a business of some sort. Okay? A lot of my students have entrepreneurial, objectives and desires for their life. They want to have a business or own a business. Maybe it's not even their sole or main source of income, but maybe it's a side income or whatever. Okay? And if that's the case, you really need to know accounting. I could tell you horror story after horror story about people who owned businesses. They didn't understand accounting at all, so they hired somebody to do their accounting, and what do you think happened? They got ripped off. Okay? I have a relative who this happened to, and in his business, and he lost $80,000 before they realized what was going on. And then do you think they could get that money back? No, they couldn't get it back. So it is very important to understand accounting concepts. And no matter where you work, even if you never co-own a business, even if you're never an accountant, wherever you work, there is a bottom line. Okay? There is a bottom line. And the financial statements that we learn to prepare and kind of analyze, those are going to be important when you go to meetings and stuff like that. Even if it's a not-for-profit. Here at JCCC, we're a not-for-profit, but we still are constantly looking at financial statements and bottom line sort of issues. So I wanted to point that out, though, right at the beginning. I'm going to go to your PowerPoints. And you at home, I emailed these to you, and I think everybody here has them. Is there anybody here who doesn't have them? I think you have them. Okay. We talked about this definition of accounting. We kind of related it to a basketball statistic example last class period. Now let's move on and let's start talking about who the users of accounting information are. Who are the users of accounting information? Well, there are external users and there are internal users. And the main differentiation between those are internal users work at the company, and external users are people who use it that don't work at the company in question. Okay? So your external users might be a bank or a credit union or any sort of lender that might be wanting to look at financial statements to see if they should give you a loan. Or if you already have a loan, to see how healthy you are, if they're going to get repaid. You might have customers who look at that. Shareholders, okay? Or stockholders, okay? If you are thinking about investing in a company, you might request a prospectus, and they'll give you financial statements, and you can look at the health of the company. Okay? You are external to the company, though. The government has an interest in looking at those. And external auditors. What is an external auditor? Well, first of all, do you know what an audit is? What is it?
It's where someone's looking to get a loan, and they have their financials like completely looked at by another somebody else, and then that person will decide if that company is able to make the payments and make it happen.
Okay. Yeah, let me hit on one point you said in there specifically. It's kind of a looking over the books. It's a looking over the financial statement. It's a testing of those numbers. Okay. When I talk about audit, a lot of times people, the first thing they think about is an IRS audit, right? And they're kind of looking over your tax returns in that specific instance and checking the numbers and testing the numbers. But an external auditor is somebody who does not work at the company that they're analyzing, but they come in, maybe they're even hired by that company. A lot of times banks will have requirements that you need to have an external auditor come in and just what you're saying, look over your books, test those numbers, and kind of give their stamp of approval. Okay? Now, before I was an instructor, I was an external auditor, which meant that I would go do audits for other companies that would hire us to come in. Okay? All right, so that's an external audit. And those are external users. There are also internal users. Okay? Now, internal users are those people who work at the company in question, okay, that's being analyzed. So it could be managers of the company, the sales staff, officers, directors, budget officers. It could be the controller. What is the controller? The controller is the chief accounting person at a company. Okay? He or she would be called the controller. The controller is the chief accounting person. Okay, so I'll use that term sometimes. CFO is a little different. The CFO is the chief financial officer. Now, sometimes, depending on the company, these will be the same people, but the controller is not so much involved in the financing issues as far as getting loans, paying back loans, bank relations. That's a CFO deal. They're more concerned with the bookkeeping. Okay, and bookkeeping is actually probably too specific of a term. Probably more all the general accounting principles of the company. All the accounting procedures, make sure they're followed and all that sort of stuff. Okay. There's also what is called an internal auditor. Now, we talked about what an audit was. An internal auditor is somebody who works at that company but does audits. Okay. A lot of companies are large enough. For example, Sprint here in town. Sprint is a large company and they have an internal audit staff. Well, they'll send somebody within the company to go to various segments of the company, test those numbers, make sure the financials there are accurate, and but they work at Sprint. They work at Sprint, and they're looking at Sprint numbers. Okay, so there's the internal versus the external. Okay, now this is not to say. Well, let me get to that in a second. Let me see if we have that slide. No, let me go back to this slide. One thing I want to point out is in Financial Accounting 1, which is this class, we're mainly focused on the information that is used by external users. Okay? We're mainly concerned in this class with the information that the external users want to look at, namely some of the 4 basic financial statements, which we'll talk about in this chapter. Okay? Now, in regards to internal users, we're not going to deal with that accounting information very much in this class. Okay? Now, that's not to say the information that we prepare in this class is of no value or of no interest to the internal users. I'm just saying that that primary information that the internal users utilize is not covered in this class. It's covered in a class called Managerial Accounting. And does anybody already know that sometime down the road they're going to be taking Managerial Accounting? Okay. The sequence here at JCCC is you take Accounting 1, then Accounting 2, and then in Managerial. And you start getting into Managerial Accounting, which is for internal users, probably the second half of your Accounting 2 class, and then entirely in your Managerial. But here in this class, we're mainly focused on the information that the external users want to look at. Okay? All right, let's go on to the next slide. Generally accepted accounting principles. Now, we talked last class period about this information that we provide needs to be relevant, reliable, and comparable in order for it to be useful in making decisions, right? Well, what helps us do that is what is known as GAAP, or Generally Accepted Accounting Principles. Okay? Now, these are the rules of accounting. Okay? Now, I know there's in this class there's a few baseball players. There are rules of baseball, right? There are rules of baseball that you have to follow, and there are rules of accounting that you have to follow. Okay? And those are called GAAP, Generally Accepted Accounting Principles. Okay? That helps ensure that the information is going to be especially comparable. Okay? That we're following that so that this year's numbers and last year's numbers are followed under the same rules. Okay? Now, who sets accounting principles? Well, there's something called the Financial Accounting Standards Board, or the FASB, and they help set principles of accounting. Okay? Now, they receive input from a lot of different groups, one of those being the SEC, or the Securities and Exchange Commission. But the FASB is the private group that helps set those accounting principles. Okay? Have you guys heard of the SEC before? Probably. In the last few years in the news, you've heard of them a lot because of some of the accounting scandals that have gone on. The SEC is the government group that they establish and help establish the reporting requirements, especially for companies that are publicly traded, okay, like Sprint, something like that, okay, or Garmin International is another one here in town, okay. Now, there's also an International Accounting Standards Board that talks about international financial reporting standards, okay. Now, this is going to be an area that continues to grow. And there is something called IFRS, which stands for International Financial Reporting Standards, okay? Now, we all know that we always say the world is getting smaller, right? Okay? 50 years ago, if you had a company here in town, chances are you weren't dealing and having transactions or sales or vendors that were overseas in other countries, right? Just because technology didn't really make that cost beneficial. But now, with all the advances in technology and transportation, all those sort of things, dealing with people overseas is getting commonplace, right? Okay? It's interesting. I have some friends. So you know what Skype is? You know what Skype is? It's a little program on your computer where it's like a camera and you can talk to somebody. Well, I have friends who have other friends all over the world. They have friends in Australia that they'll talk to and friends in England that they'll talk to. Well, it's the same way with businesses, okay? There's all sorts of international transactions now. So now we're saying, okay, well, what are we doing now? Because we used to have all these different standards for different countries. So what they're trying to do is get more of a uniform set of rules, okay? More of a uniform set of rules that people have to follow. So we are in the process here in the United States of kind of moving from pure U.S. GAAP, U.S. generally accepted accounting principles, to more of an international standard. Does that make sense? So that is still in play, and over the next few years you might even be reading about that. Okay. All right. I'm going to switch gears a little bit. We talked about starting your own business. Let's say you were going to start a landscaping business, okay? Well, there are three main types of ways that you could organize that business, okay? You have to establish what type of business you're going to be. Not what you're going to do, but what sort of entity it will be, okay? The three main ways you could start your business is you could establish it as a sole proprietorship, where there's just one owner. You could do it as a partnership, which means there are two or more owners. Or you could do it as a corporation, okay? Now, a corporation, real briefly, and we'll talk about this a little bit more, but a corporation is when you set up that business as a totally separate legal entity, okay? Now, when you look at this slide that's up there, you might think, okay, this is easy. One owner is a sole proprietorship, just a few owners is a partnership, and if you have a whole bunch of owners, it's a corporation. Not necessarily so. You could have just one owner in a company, and you could set yourself up as a corporation. So it's not the number of owners that differentiates a corporation from these other types. It's whether you have gone through the steps necessary to establish it as a separate legal entity, okay? But there are many more, when we think of corporation, we think of places like Sprint or Hallmark, that have hundreds, if not thousands, of employees. There's many more corporations in the country that just have one or a few owners, okay? We just immediately shift over to the big ones, okay?
An example between sole proprietorship and corporation, like.
Okay. What I'm going to do is let me move to this slide right here, And I think this will answer your question for you, because we're going to contrast the sole proprietorship versus the corporation in regards to several characteristics, and I think this will help differentiate that. Okay. Okay. Now, regardless of how you set up your business, it is a separate business entity. Okay, regardless of how you set it up, it's a separate business entity, which means that you keep its records separate from your personal records, right? Okay. Now, if you had a business, Peter, a landscaping business, you wouldn't want to write checks out of your personal checkbook and keep all your personal stuff commingled with your business stuff. You'd want to kind of have that be a separate set of records. You see what I'm saying? So regardless of how you organize your business, you want it to be a separate business entity. Here, though, is where it's different. The legal entity. A corporation is a separate legal entity. A corporation is almost like the creation of an artificial person. Okay? When you set up a business as a corporation, that is its own entity. A corporation has its own rights and responsibilities. It can sue, it can be sued, it can enter into contracts. It is separate and apart from any one human being, okay? For instance, I used to own stock in PepsiCo. PepsiCo is a corporation. Well, as a shareholder, as a stockholder, I was an owner of PepsiCo, was I not? But if I died, would PepsiCo keep on going? Yes, it is a totally separate legal entity. So the difference, one of the differences between a proprietorship and corporation, going back to your question, is the process you go through in establishing your business. It's very easy to start a sole proprietorship. Very easy to start a sole proprietorship. But for a corporation, you have to go through the process of getting articles of incorporation. Usually you hire a lawyer. There's a lot more, bureaucratic steps, so to speak. You have to register with the government. But that's the main difference, is whether you go through those steps. Does this make sense? Okay. Only a corporation is a separate legal entity. Now, why would you want to do this? Why would you want to go through those steps? Well, one of the big reasons is in regards to your liability. And we see limited liability. Corporation has limited liability. Proprietorships and partnerships do not have limited liability. Okay? All right, so let's talk about this. What is limited liability? Okay? All right, let's go to a real-life example here. Is it Gil? Okay, let's say you started a landscaping business, okay, and you were a sole proprietorship. You're the only owner, okay? So you set this thing up as a sole proprietorship. Well, let's say that you are mowing lawns and there is an accident and you run over a kid or something like that, okay? Horrible mowing accident. Okay, could those people come and take the business assets and sue you? Yes, they could. Could they come and attempt to take your personal assets? Yes, they could. Okay? They could come try to take your personal assets. If you have a home, if you have a car, if you have savings or whatever. They could sue you and your personal assets are at risk because you are a sole proprietorship. So on that slide where it says limited liability, it says no for sole proprietorship. What you have in a sole proprietorship is actually unlimited liability. And that's a bad thing. That's a scary thing. Unlimited liability is it with a sole proprietorship. Now, let's say you have a partnership, okay? Let's say it's Gil and Zach's business. There's two owners. You have a partnership, okay? Let's say he runs over somebody with his mower. Could they come and take your personal assets? They actually could. Now, that's one thing to have somebody come after your personal assets for something you did stupid, right? But what about something that your partner did, right? You'd be a little ticked off, right? Again, a partnership does not have limited liability. A partnership has unlimited liability. What about a corporation? Well, let's say that you two guys decided to incorporate your business. Or you could have even incorporated just by yourself, Gil. But let's say you two guys decided to incorporate your business. Well, let's say you have that same lawn mowing tragedy occur. They could come try to take your business assets, but they cannot come take your personal assets. Are you with me? So do you see why one might want to set up as a corporation? Because it protects their personal assets. Sometimes you will hear of these sort of cases discussed in the paper where somebody is being sued, and if they're sole proprietorship or partnership, they're coming after their personal assets. But if you set up as a corporation, they cannot come take your personal assets. Does that make sense? Another example, when I owned stock in PepsiCo, I was an owner of PepsiCo, one of thousands, right? If PepsiCo did something stupid, maybe they put some poison in their Pepsi accidentally, and a bunch of people died. Could people come try to find one of the owners, Dave Krug, and take his personal assets? No, they can't. Now, my stock price might drop to 0 because of the harm that it does to the company, but they cannot come take my personal assets. Does that make sense?
So that's a business. And my mom is the owner of the actual building and the land, and then my dad runs the company, and they have it as a corporate, both are separate corporations.
There's a lot of different real legalese reasons for doing that, but probably one of the reasons is so that if one of the companies is affected, it cannot harm the other entity, the other corporation, or your personal assets. Okay? It gives more of a distinction. Okay? Good. So is limited liability something you'd want? Yeah, it is. Okay? Now, there's some asterisks on there. There are certain types of businesses that you can set up that are a lot easier than a regular corporation that will give you limited liability. Has anybody ever heard of the term an LLC, or limited liability corporation? That's a specific type of entity you can form your business as, and you have that benefit of limited liability. Okay? But that option is only available for somewhat small companies. Sprint cannot set up as an LLC. Okay?
What's the mark off there? What's the difference?
How many owners? Is that what you're asking?
No, like what's the difference between, what's the cutoff that says, okay, well, you're too big?
Well, I don't know specifically how many owners it is. It seems like it was like 25 or 30, but I'm not sure exactly what that number is. All I know is that when you certainly get to that size, you're too big to be an LLC. Now, Sprint wishes they could be an LLC, and I'll tell you why here in a second. Okay, but they can't be. And keep in mind with some of this stuff, a lot of this stuff goes way beyond the scope of this class as far as the legal issues and all the different business laws associated with these types. Okay, so a lot of this I am not aware of every little specific legal, jot and tittle about each sort of entity, but we want to make sure we just get the basics. Okay. Unlimited life. Proprietorships and partnerships have a limited life. So no on the unlimited, they have a limited. Again, your sole proprietorship. If you die, that business is over. Okay? Your partnership, if one of you guys dies, that business is over. Now, you may choose to get another partner and go on as a different partnership, but partnerships and in sole proprietorships, you have a limited life. Corporation has an unlimited life. Okay? If I died when I had that PepsiCo stock, the company would just keep on going, right? They probably wouldn't even mourn my death, right? They would just keep on going. Okay? They have an unlimited life. Okay, here's one I want to focus on. Because right now you might be thinking, hey, seems like the thing to do is to incorporate so that I can get that limited liability. Well, hold on there. Okay, is the business taxed? Sole proprietorships and partnerships are not taxed as the companies themselves. Now, does that mean you guys as a partnership get to enjoy a tax-free life? No. Okay? All that means is that the company itself does not pay taxes. And then you have certain distributions that go to you as owners, and you guys pay taxes on the personal level. But the company itself does not write a check for taxes. That's the case for sole proprietorships and for partnerships. For a corporation does have to pay taxes. Sprint has to pay taxes. Now, I want you to consider this. Does anybody here own stock in Sprint? No? Okay. Well, I own stock in PepsiCo. Okay, I told you that. PepsiCo is a corporation. So I'm going to make this real elementary. Let's say you're PepsiCo. You got a big pile of money, right? At the end, you have a pile of money. After all your income, net income, and all that sort of stuff. Well, you have to pay taxes to the government, right? So now you pay taxes, and now you have a smaller pile of money, right? You understand this concept, right? Big pile of money, pay taxes, smaller pile of money. Anybody who works for a living, look at your paycheck, and you'll understand that concept real quick, okay? So PepsiCo paid money to the government, and they have a smaller pile of money. Now they want to give some money to their owners, such as Dave Krug. So they write me a dividend check out of this smaller pile of money. They write me a dividend check. Do I have to pay taxes on that dividend? Yes. Yes, I do. Now, that may seem unfair because you're like, well, hasn't this money already been taxed? And then you're distributing it to owners and they have to pay taxes again? Yes. That's the big disadvantage, one of them, of being a corporation, is there's what's called double taxation. Okay? Double taxation. That's not the case with your partnership because the company never paid taxes. Does that make sense? As a matter of fact, when I used to get my PepsiCo check for dividends, right in the small printing there used to be this, and it said something like, the dividends you are receiving are taxable. However, they are distributed from monies that have already paid taxes at PepsiCo. If you think this double taxation is unfair, please contact your congressperson or something like that. Of course, I never did. But corporations hate that there's double taxation. They really wish that their owners didn't get the money after it's been taxed twice. Does this make sense? Now, the benefit of an LLC, the LLC is the best of both worlds. You have your limited liability, that's good, and an LLC does not have to pay taxes itself. That's good. And then you might think, well, why doesn't everybody be an LLC? Well, again, that's when you get into the rules. And I don't know every specific legal rule, but I do know that one of them is a company the size of Sprint certainly cannot be an LLC. Lauren?
What do you mean by itself doesn't have to pay itself? Like, because it says, like, say you're a sole proprietorship, but you're limited liability, and you say you yourself don't have to pay business taxes. Well,
okay.
what
Let me hit that again. Like, it's with these guys. Let's say they have a partnership. Let's say it's called Zach and Gills Landscaping. Zach and Gills Landscaping does not have to write a check to the IRS. They just do business. They file an informational return, but then when they do their personal returns individually, that's when they pay taxes.
Oh, just from their income?
Yes, from their income. That's probably largely income from Zach and Gills Landscaping. Now, if you guys were a corporation, Zach and Gills Incorporated, then Zach and Gills would have to write a check to the IRS, pay taxes, and then you'd have to pay taxes at the personal level as well. Okay. Does that make sense? Okay, good question. All right, any other questions? Lastly, is one owner allowed? Any type of these business entities can have just one owner, except for a partnership. Partnership, there's two or more, okay? All right, so this is always, you might put a star on this little grid here. It's in your book as well. This is usually worth a good couple of multiple choice questions on the test, okay? Now, I'm not the kind of instructor who's going to give you this empty grid and make you fill it in, but I could certainly ask these in a multiple choice sort of a way. But I certainly want you to understand that concept of limited and unlimited liability and in regards to the taxation, okay? Make sense? All right, let's move on to something else. We're jumping around a little bit. All right, this is important. This is your new buddy, the accounting equation. Assets equals liabilities plus equity. This is important, okay? Now, just like with anything, when you start something out, you have to trust the person who's giving you this information, right? It's just like baseball or basketball, and I'm teaching my kid how to play baseball, and I teach him how to hold the bat. Now, he just trusts me that this is the way to hold a bat. If I was really mean, I could teach him some weird way to hold the bat, and he would, why would he not take that to be true? Okay? It's the same way with accounting. I want you to memorize this accounting equation. Assets equals liabilities plus equity. I want you to memorize it, and I know fully well you don't understand all the implications of it. Okay? Now, I'm going to define each one of these terms today, but I want you to know the accounting equation. Assets equals liabilities plus equity, or sometimes called owner's equity. Let's talk about these terms and what they mean. Okay? Okay, I think we're somewhat familiar with what assets are. Assets are resources that are owned or controlled by a company. Okay? For instance, if you have cash in the bank, that is an asset. If you have cars or vehicles or buildings or equipment or supplies, land, those are all resources that your company owns. Those are assets. Okay? Now, there's a couple here that we may not be that familiar with. Accounts receivable and notes receivable. Let's say accounts receivable, an example would be, let's go back to Zach and Gil's landscaping. Let's say you guys mowed some lawn, a big lawn, and it was a $150 landscaping job. You did a bunch of other work too. And they said, hey, can we just pay you next week? And you said, fine. Well, you would have an account receivable from that customer. You see what I'm saying? Because in a week you're going to receive that $150 in cash. But that account receivable, that is an asset. Okay? Similar to that is a note receivable. A note receivable is also an asset. It is a little bit more formal. There's usually interest involved. There's usually papers and stuff that you have to sign. Does anybody here have a car loan? Anybody here have a car loan? Okay. The bank has a note receivable from you with your name on it. Because when you got that car loan, did you have to sign stuff? Yeah. Did you have to, or do you have to pay interest? Yes. That's a note receivable. A little bit more formal. An account receivable is just, hey, can I pay you next week? But those are both assets. You with me? Now, this stuff you can read about in your textbook, and I want you to as well. What about liabilities? Well, unfortunately, most of us know what liabilities are. They're debt, right? Does anybody here have a student loan? Then you have a liability, right? Now, let's define these real quick. Accounts payable. Now, you guys mowed the lawn of that business and they owe you $150. You have an account receivable from them. The company that owes you the money has an account payable to you. That's a debt. Does that make sense? I have an account, this company has an accounts payable. They owe you $150 that they have to pay you next week. What is a note payable? It's just the flip side of a note receivable. The bank has a note receivable from you guys for your student loan or car loan. You have a note payable to the bank. Okay? It's a debt for you. It's an asset for them. Make sense? Other types of liabilities. Let's say that you owe your employees some money and you're going to pay them in a few days. Well, that's called wages payable. Or if you owe the government money and you have to pay them, that's taxes payable. Anything that ends in payable is a liability. Okay? And we'll learn about some other liabilities as we go along. But do you understand the concept of liabilities? It's just debt. Okay? Now, we've talked about assets. We've talked about liabilities. We've talked about the accounting equation. Assets equals liabilities plus equity or owner's equity. What is this equity thing? What is this equity thing? Okay? Now, equity is the one that's a little harder to get your arms around. Okay? A lot of times you've heard the concept of equity in regards to a home. Like, do you have any equity in your home? Okay? Let's talk about what equity is. Now, equity is actually best learned by how equity changes. And we're going to talk about that in a minute. But equity can kind of be thought of as the owner's claim or the owner's share in the business itself. Okay? Let's talk about this. Specifically, I want to talk about how does owner's equity change? How does it increase? How does it decrease? Now, for you folks here that are live, I'm going to tell you right now, at the beginning of next period, we're going to have a quiz. I'm going to tell you exactly what's on that quiz. I'm going to ask you for the accounting equation, assets equals liabilities plus owner's equity, and I'm going to ask you, how does equity change? Specifically, what are the two ways that equity increases? What are the two ways that equity decreases? That's the whole quiz. Okay? But I know from teaching this class many times that those are very foundational issues that if you get them into your brain nice and solid, everything's going to go a lot easier. For you folks at home, I can't give you the quiz, obviously. I can't come to your living room and give you the quiz. And I won't film when we give the quiz here, but we'll turn the cameras on when we're going over the quiz. Okay, and you can see how you would have done. I want you to know the accounting equation. I want you to know how owner's equity changes. Now, there are two ways that owner's equity changes. Oh, I'm sorry. There are two ways that how owner equity increases. The two things that cause owner's equity to increase are these. First of all, investments of assets by the owner into the business. Investments of assets by the owner into the business. This could be cash or this could be equipment, any type of asset. For example, going back to, let's say, Gil, it's a sole proprietorship, your landscaping business, right? If you put in, let's say your grandmother died and left you $5,000, and so you put that into the business. That is an investment of assets into the business, and that causes your equity to increase. You with me? Let's say that you also had a truck that was paid for, and let's say you donated that pickup truck to the business. That's another asset. That also causes your equity to increase. You with me? Any investment of assets into a business causes equity to increase.
So then how would that split up? Like, what about him?
Well, we just did this as sole proprietorship.
Oh.
He decided he didn't want to be partners with Zach. Okay.
What if you had that situation?
If you did that, then you would keep track of his equity and his equity. What he put into the business and what he put into the business. Okay?
So it's separate from like the business, like somebody gave, like you took like $5,000 of your own money,
yes,
and put it into the business.
That's exactly true. That would be different than if you went and got a loan, the business got a loan. That would not be increased equity. That's a great question. Now, and also, I'm going to get away, now that we're done talking about the three types of business forms, I'm going to get away from the partnership. Because Accounting 1, this class is mainly going to talk about the sole proprietorship type of entity. Okay? You'll talk about those other types in Accounting 2. Okay? But any investment of your personal assets, Gil, into that business increases your equity. You with me? Let me tell you the second thing that increases equity. The second thing that increases equity is revenue. What is revenue? Well, let me give you an example of what revenue is. You're probably somewhat familiar with this term. Okay? Let's say that you mow somebody's lawn and they pay you a couple $100. That is revenue, right? Okay? Let's say after class today, you go to Best Buy and you buy a couple DVDs, $40 worth of DVDs. That is $40 of revenue for Best Buy. Okay? Let's say that I'm a lawyer and I do some consultations for people. $300 worth. That is revenue for my business. Let's say you go get a haircut and you pay the hairdresser $20. That is $20 of revenue for her hair salon. Does that make sense? Okay. Now I'm speaking in kind of elementary terms as opposed to real technical accounting terms because we don't know all our technical accounting terms yet. Okay. So I'm specifically not using specific principles that we will build on this. But suffice it to say, at this point, I've given you some examples of revenues. Revenues also increase owner's equity. You with me? So what increases owner's equity? Two things. Investments of assets into the business and revenues. Okay? Now, when I give this quiz, I'll get lots of weird answers. Like cash. Somebody will put cash. That's not really an answer. Cash doesn't always increase equity. The example that you gave, if your business went and got a loan of $500,000, you'd have more cash, but that does not increase equity because there's a liability established there as well. Don't make it harder than it is. The two things that increase equity are investments of assets by the owner into the business and revenue. That's the question. Those are the answers. With me? For now, trust me and just memorize those, even though you don't understand the full implications of them. Okay? What are the two things that decrease equity? Well, it's the flip side of these. The first thing that decreases equity is withdrawal of assets by owner out of the business. This should make sense, should it not? Gil, when you put assets into the business, that increased your equity, right? But when you take assets out of the business for your own personal use, that decreases your equity. Now, the main type of this or example of this would be when you take money out of the business. Because if you have a landscaping business, chances are you have it to support your life, right? Well, what happens when you need to buy groceries and pay your apartment rent and, pay for stuff like that? Well, you take money out of the business, and you can do that. That's why you have the business. But when you take assets, namely in this case cash, out of the business, that decreases your equity. You with me? This should make sense. Put assets into the business, that increases your equity. Take personal assets out of the business, that decreases your equity. You with me? Okay. What was the second thing that increased equity? Revenues. So what do you think the second thing that decreases equity is? The second thing that causes owner's equity decrease is the opposite of revenues, or expenses. Expenses decrease equity. For example, in your landscaping business, you might have gasoline expense, or you might have salary expense if you have an employee. You might have advertising expense. Okay? Those are things that you pay for because they're necessary to keep the business going, right? Those expenses decrease owner's equity. Make sense? So think about this. The two things that increase, and I know I'm sounding like a broken record, or that probably doesn't even resonate like it used to. I sound like a CD that's playing over and over again, right? I keep saying the same thing over and over. Yes. So you're familiar with the concept. Good. And you'll learn this about me. When something's really important, I keep kind of repeating it. Okay? Because I want to get it into your heads. I know what it takes to be successful in this class. And these are those first principles, these first small concepts, that once you get them, everything starts to become easier because we have a foundation to build on. The accounting equation, assets equals liabilities plus owner's equity. Always, always, always. The two things that cause owner's equity to increase: putting personal assets into the business and revenues. The two things that cause owner's equity to decrease: taking assets out of the business for your personal use and expenses. Understand? That's the quiz you'll have. Okay? I want everybody to get 10 out of 10. Okay? For you folks at home, even though I can't quiz you, learn that because everything will be easier. All right? Lauren?
Like you said, if you take for equity to decrease, if you take assets out of your business, is the only way to increase it again is to put more in? Or like say like they have a landscaping business and they take money out because they got to pay their house payment or something like that.
Right.
And then,
Well, the main way you're hoping to increase equity in the business is through revenues.
okay.
Because there's a limit on how many assets you're going to put in. You're going to put, when you start the business, you'll put a lot of assets into the business. But the main way that you're hoping to increase equity over time is by having more revenues than you do expenses. Okay? Good question. Okay? All right. Very quickly, we have about 2 or 3 minutes, which is really all it's going to take to go through that homework that I assigned. So let's take a look at that real quick. Okay, I'd like to get that done before we leave today. The first one I assigned, I believe, was the Quick Study 1-1. Okay? And this just asks whether the following users are external or internal users. Okay? All right, so let's go through this, and this will touch on some of the concepts that we covered today. Shareholders are external, aren't they? Lenders are external as well. And again, we're on Quick Study 1-1 on page 28. Controllers are internal. The FBI and the IRS are external, as well are consumer groups. Those are outside of the company, those are external. The sales staff, internal, correct? Customers, suppliers, and brokers, the next 3, are all what? External. The business press, such as the Kansas City Business Journal and those sort of things, those are external, right? Managers are internal. The district attorney, external. If I put that on the Elmo real quick, here are the answers. You can double check them, okay, for Quick Study 1-1. All right. The next one I assigned, I think what we will do is we will cover those the other 2 exercises that we assigned, which was exercise 1-2 and 1-7. We'll go over those next period, okay, because I think we're going to run out of time here, and I don't want to hurry through those too much, okay? However, I want to add to your assignment, okay? So let me go ahead and assign just a couple of more. I want you to do Quick Study 1-7 and 1-8. Okay? Quick Study 1-7 and 1-8. However, we are also going to go over exercise 1-2 and 1-7. Because those are the ones I assigned for today that we didn't get to. Is that correct? So that is your homework. Those are the things that we'll go over next time. I want you to read your textbook. You paid a lot of money for that. The textbook will go into more detail on all these concepts that I described. And remember, for you folks here, we have a quiz right at the beginning, okay? We'll do that real quick. Don't be late to class or you'll miss it because it's a real quick one, okay? All right, keep up, guys. Don't let yourself get behind in this class and you'll do great, okay? We'll see you later. Bye.